Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates. While Powell's speech is something market has been waiting for, the geopolitical situation seems to have grabbed the center stage once again, with strikes being carried out against the US bases in Iraq. Situation seems tense and gold's rally showed the same. But on the domestic front, we did see rupee appreciate in the NDF markets. Good morning, JK. I'm sure our listeners would like to know your take on the rupee. Is it showing signs of topping or is it a buy on dips market? What do you think?
Good morning, Swaraj. Yes, we did see some sell-off in the USD INR yesterday. In fact, it started towards the close of onshore trading hours and continued in the NDF market. It could have been some flow or a combination of flow plus central bank selling, but nothing in the fundamental or technical points to sustained gain for the rupee. So I would still be a buyer of USD INR so long as 82.90 is not breached on a sustainable basis, because the factors governing the rupee moves are still negative. Oil prices is once again higher today. Brent trading above 93, and the US yields are pushing higher. Yeah, come to what the major events of yesterday. Powell's speech was obviously the major focus of the market, and the key takeaways from his speech is that most likely the November 1 meeting would be another pause, and that's almost signaled by him. But future actions beyond December or beyond is a lot dependent on incoming data, evolution of other risks in the economy, etc. So that's one thing. Secondly, he also pointed to the yields, which the Fed is not trying to control. Rather, they would like to see it play out. And he actually highlighted the fiscal position of the US government, which is unsustainable, which is mainly leading to the yields going up. And of course, he also pointed to the fact that the Fed themselves are turning into sellers instead of buyers, changing their stance from QE to QT. And as far as the future rate hikes are concerned, obviously, market presumes that there will be no hike, and that's why they took it as a dovish stance from the Fed. Of course, he also pointed to the labor market, which is showing signs of cooling, and how the wage increases are moderating. Now, the market reaction was quite choppy. Initially, the dollar, fell, and yields also came off a bit. But in the end, nothing seemed to have changed for the direction of the yields. And we did see 30-year actually breach 5% in yesterday's European trading and sustaining well above it. Now, the 10-year yield almost touched 5% and trades about 5 basis points lower. Now, the key point on the long-term yields rising is the what the market is trying to assess is whether it is because of superior growth outlook of US, or it is because of the element of supply and concerns of long-term fiscal policy. So if it is growth that is driving it, it is very bullish for the dollar. And if it is the fiscal policy, and at some point we are going to see a crisis, and that will be actually dollar negative. So this is something that we need to assess going forward. And the other focus of the market, obviously, the geopolitical front. There are several indications that it is not easing. The Israeli troops apparently are waiting for a clearance from the political bosses to go ahead for a ground attack then Israel is also asking to all their citizens residing within the Lebanon border and to move out from Middle East and to and the North African countries. So the tensions there are not easing enough. The market yields, obviously, as I said, saw a new high yesterday, and on the dollar, again, it was a choppy day, but all confined within a range. We are not breaking out of the range. Dollar index ended 0.3% lower, but that was heavily influenced by the euro's recovery back to 1.06. Once again, of course, euro is finding it difficult to sustain a recovery above 1.06. We are still waiting for some strong trigger to move it either way, below 1.05 or 1.06. Sterling looks a bit weaker. after the recent string of data indicating that the UK economy may be coming under stress. Japanese yen is making a very, very small stride towards 150, and market is really not confident of pushing it in a hurry, and because of the fears of intervention. I'm sorry, the CNY actually has had breached 7.34 yesterday when the dollar was at its strongest level, but since then it has eased off a bit below 7.33, but still trading at much weaker level. Now come to the rupee part. While rupee was trading in a narrow range yesterday, and in all probability is likely to trade between 83 and 83.30, lower levels being unsustainable. We did have some important points emerging from the monthly bulletin of RBI published yesterday. This was pertaining to August, and it shows that RBI had net sold 3.86 billion in spot foreign exchange market in August, and this was against almost a similar amount that they had purchased in the month of July. But interestingly, their forward book purchases have come down from 19.47 billion to 10.07 billion. RBI, of course, intervenes both in the spot and the forward market. Therefore, there has been a large decrease of almost 14 billion in their overall reserves. That is very significant, and that is reflected in the exchange rate being held very steady. Another point of note in the RBI bulletin is the RER, which was earlier closer to 106, so it means 6% overvaluation, has come down to about 104 in the month of August. But then we have to take note that in the month of August, we had dollar index rising by nearly 3%, and the emerging market index also dropped by nearly 1%. Emerging market currency index also dropped by nearly 1%. All this means that rupee has not kept step with these currencies, and once again you would find that in the end of September you would have the RER once again inching up towards 106 or so. So we are not seeing any correction in the real effective exchange rate of the rupee. And also on the point of intervention, we know that in the September month as well as in October they have been selling much more. Therefore, one should say that it is a record amount that the RBI would be shelling out to protect the INR. We do not know the timing when the RBI also considered rupee to adjust itself towards the in line with the fundamentals, particularly the global fundamentals, which are turning slightly negative for the rupee. So that's something we'll have to wait. It's a very thin day as far as the data is concerned, excepting UK retail sales. However, market will keep an eye on the developments in the Middle East as well as the yields going forward. Thank you.
Thank you, JK. And of course, with Powell's speech, what markets took out was November meeting. There might be a pause, but future actions beyond that is sort of data dependent, and markets took it as a dovish stance. But he did say labor market is showing some signs of cooling. On the geopolitical front, people near Lebanon border in Israel have been asked to evacuate. So it's an evolving situation, and I think we'll have to see how it goes. And when it comes to USD INR, we saw some sell-off which started towards the close of the onshore market. And as JK mentioned, 8290 is an important support. That's it from us today. Thanks for listening. Have a very good weekend, and we'll see you all on Monday with the latest in the financial markets.